Welcome to Chapter 18, where we discuss brokerages, account types, and annuities. I'll tell you, the stock market is bad. It's even worse than a divorce. You lose 50% of your net worth, but you still keep your spouse. I don't know that this is a Rodney Dangerfield joke, but it sure sounds like one, so we're going to give him credit. And have you ever wondered why they call us brokers? Yeah, right. Oh, somewhat. In this chapter, we'll discuss where you're going to store your securities, where you're going to store your stocks, bonds, mutual funds, and also discuss different types of accounts, and then thwack annuities. There were three different types of brokerage firms, but now really only two. There's the full service traditional Merrill Lynch and Morgan Stanley. They provide investment recommendations and take you to the steakhouse and golfing and charge you accordingly. And then we used to have discount versus deep discount brokers, but it seems like most everybody now is deep discount. There is still a few of the sometimes called mom and pop shops like LPL Financial and A.G. Edwards and the like, Edward Jones, where you'll still get personal service, but you won't be charged as much as Merrill Lynch or Morgan Stanley. But the biggest movement has been in the deep discount, where Schwab used to be a discount brokerage. Now they're joined the ranks of the Robin Hoods and Scottrade was bought by TD Ameritrade, which was then bought by Schwab, which they emphasize technology to reduce brokerage costs dramatically. So what can you expect to pay for each? What kind of service can you expect from each? Well, think about it, right? Commissions then and now. Traditionally, virtually all brokerage firms made their money from commissions. It used to be that full-service brokers would charge you $70 to $100 or more per trade, and then the discount brokers started at $45, then went down to $29, then went down to $19, $13, right? And now the deep discount brokers charge for $5 to $10 or even less, zero commissions. And the mutual fund companies didn't stand still. They now offer brokerage firms. Yes, of course, it looks like Fidelity, but it's a different company. It's a Fidelity Brokerage Services as opposed to Fidelity Funds, but they might as well be one company. To us, it looks like one company. And then a few companies experimented with $0 commissions. One failed, one now charges $5. But the one that has been most successful with that is Robinhood. I think I'm not a big fan of Robinhood. I don't use their service, so I really shouldn't say. But from what I can glean, it sure looks like they're trying to make it into a video game, and they're trying to get you excited about trading as often as possible, saying it's free, it's free, it's free. And if you still think it's free, go back to chapter 3 and realize that no, you're getting charged. They're not doing this for their health. I mean, obviously, if you don't eat, you don't, get sick. But yes, they're charging you. How can a brokerage firm make money on a $5 or even a $0 commission? Does this slide look familiar? Scottrade now is owned by TD Ameritrade, which is now owned by Schwab, but Scottrade Incorporated receives remuneration for directing orders to particular broker-dealers or market centers for execution. Such remuneration is considered compensation to the firm, and the source and amount of any compensation received by the firm in connection with your transaction will be disclosed upon request. But in Scottrade's defense, at least they included this, even though they don't want you to read it. That's why they put it all upper caps and use words like remuneration. They put it in every email confirmation that they sent you. But still, what's going on? You know what's going on. And if you don't, again, go back to chapter 3, or the third presentation, where we see that you're not getting the best price. Now, have brokerage costs been reduced? Yes, dramatically. But still, it makes me upset that that people like Robinhood are not being very transparent about how they make their money. Slide number 5, as the competition for your business has gotten fiercer, the methods of charging investors for investment services have gotten more creative. Alternative methods of I'm charging your clients. Several years ago, Merrill Lynch experimented with charging people $3,000 a year for unlimited trades, but they don't have that program anymore. There are many other methods, but the modern day go way to soak your customers, charge for brokerage services, is called assets under management. Now, hopefully you remember this back from Chapter 2 when we talked about the share classes of mutual funds. If not, go back and review it, because you're the investment guru. You have to understand share classes. You have to understand how people are being charged for their mutual funds. Assets under management, also called wealth management account, wrap account, investor advisor account. Instead of charging commissions per transaction, the brokerage firm tacks on a yearly 1 to 2% assets under management wealth management fee. We're not your brokers anymore. We're your wealth managers. Remember the F shares, the FI shares, the I shares? These types of programs are being pushed by all the major full-service brokerage firms, and there are many flavors of this program. The latest wrinkle to this method is the new performance-based wealth management program. Slide number 7. Performance-based wealth management. Only pay your advisor when you make money. The advisor receives 10 to 20% of your earnings when you make money, but the advisor receives nothing when you lose money or don't make anything. It's a variation of the way hedge funds charge their shareholders, marketed to high net worth individuals. And the first one I saw was in a presentation of Denham and Associates, which is based here actually in Del Mar area. And when I saw this, I said, the first, it's very tempting, isn't it? You only get charged when they make you money. If they don't make you money, if they lose money, they don't charge you. I thought the first bear market comes along, they're going to have to change their business model. And indeed, that's what happened. And when 2008 to 2009 came along, they had to alter their fee structure. They charge you now much less if you lose money or don't make money. But still, the reality is you're going to have the potential to pay far more for your investment services using this method. And if you don't believe me, go back to Chapter 2 and look at the difference between the A shares and the F shares over time. Yes, but as I said, I don't even remember this story. The one guy said, what are you worried about? Because I said, I don't think this is in the best interest of the clients. And the guy just looked at me and said, what are you worried about? Send them a bottle of wine on their birthday. Take them to the steakhouse golfing. They'll love you. Okay. Yeah, and that guy, obviously, he was oozing of money. So, not for me. Thank you very much. How about anti-brokerage firms? How about direct reinvestment plans, DRIPs? Remember these from Chapter 3? Bypass the middleman. Many of the large, well-established companies offer their own dividend reinvestment plans. Some are totally free. Some are very close to free. If you remember the presentation in Chapter 3, I was in an investment club, and we had Semper Energy, SDG&E, and they had a DRIP. And every once in a while, every quarter, we get charged 6 cents or 9 cents, or it's very, very little money. But they're not perfect, right? What if you had to sift through 18 different statements, right? You had 18 different DRIPs. But there are some companies like Interactive Brokers that allow you to keep all your DRIPs together. And now most all of the major brokerage firms, we offer it, allow you to have direct investment plans, which will automatically buy more shares with your dividends, which is, basically what you want. Unless you're living off the dividends, unless you're using the dividends for income, you want to have more shares. And before, you had to wait until you gathered up enough cash in your account and then to buy more shares. and get charged a commission. This is many years ago, and so some of us still charge a commission. But now, no, automatically without a charge or very, very little charge, you buy more shares of that company. Very, very cool. I'm a big fan of drips. Okay, now let's change gears and take a look at the different types of accounts. And here's where some confusion comes in, because people will ask the question, well, what kind of money can you make in a Roth IRA? What am I going to get in a Roth IRA? That's the wrong question. The question should be, what kinds of returns can I get with the investments that are located in my Roth IRA? I am not very savvy with graphics, so these are supposed, on slide number 9, these are supposed to be bins or buckets or bolsas, containers. And there are two major types of containers. There are taxable accounts, regular taxable accounts, non-qualified is what the IRS calls them. And then there are tax qualified accounts. The vast majority of them are retirement accounts, but there are also educational savings accounts, health savings accounts, flexible savings accounts. These are all identified in the Internal Revenue Code. With a regular taxable account, you can have any type of security, real estate, even gold if you wanted to. That's a little bit more tricky. In your account, there's no limits on your contribution. There's no limits on the investment types. You pay taxes every year. That's why it's sometimes called a taxable account, a regular account. The IRS, as I said, calls them non-qualified accounts. Retirement accounts, educational savings accounts, health savings accounts, they have strict limits on contributions and on the investment types. So notice, in the Bolsa here, of a taxable account, we can basically put anything. Stocks, bonds, options, futures, shorting, mutual funds also. But with a retirement account, an educational savings account, health savings account, with a tax qualified account, we are limited. Stocks are risky enough. So you can have bonds, mutual funds, cash. Actually, you can put gold into an IRA. Don't do it. It's very dangerous. And you can actually put real estate into an IRA. But again, don't do it. You got to know what you're doing, or find a qualified, competent third-party administrator trustee to hold on to the funds, to the items, because you can. Oh, there's a link to an article of a couple who put gold in their IRA and then wound up, having to pay the IRS a tremendous sum of money because they didn't know what they were doing. So although there are many subtle and not so subtle differences, the major differences are how they are taxed by the IRS, how much you can contribute, and what you can have in the account. And we're going to now go through many of the very popular retirement tax qualified accounts. Slide number 10, types of retirement accounts, types of retirement tax qualified accounts. Well, they basically fall into two categories: pre-tax, or sometimes called before tax, and post-tax, sometimes called after tax. Do you want a tax break now, or do you want a tax break later? The pre-tax are far more older than the post-tax. So 401ks, 403bs, 457s, 401as, what silly names. Where do they come from? The section, the provision in the Internal Revenue Code, section 401k, which says if your employer does this and you do that, Domini Sanctus, you can put away money, tax deferred, grows tax deferred until you retire, and then when you take it out, you get taxed then. But that makes sense because in retirement, we're usually in a lower tax bracket than when we are working, right? Yeah. Well, if not, congratulations. If you're in a higher tax bracket because you're taking out so much money from your retirement accounts, I'm very, very happy to hear that. I want to congratulate you. In fact, that's what I hope happens to you and all my students and my clients. Yes, it's a terrible champagne problem. The traditional IRA, now it used to be called the IRA, now it's called the traditional IRA, to differentiate it from the Roth IRA, is for everyone. And 401ks and 403bs are for people who have jobs where the employer sponsored them. That's why they're sometimes called employer sponsored plans. For smaller companies, smaller businesses, there's the SEP IRA, the Simple IRA, the KEO, which is no longer offered to new programs, to new businesses. But if you have one, you can grandfather it in. You get a tax break now. Your deductions, you get to deduct the contributions from your income tax. The money grows tax deferred, and you pay taxes in retirement. Very cool. Starting in the late 90s, there was a new kid on the block called the Roth IRA, named after William Roth, the senator who proposed the idea. And these don't give you a tax break now. They give you a tax break later. You put the money in now, after tax, post taxes, it grows, doesn't you don't have to pay taxes as it grows. But then when you go to take the money out, it's tax free. Yippee! And notice we put Roth 401k, Roth 403b in quotes because that's not their legal names. They're just the same plans, 401ks, 403bs, that allow you to put in money after taxes. Okay? So these are the two main categories of retirement accounts, pre-tax and post-tax. So let's go to the next slide. Come on, sweetheart. Okay, there you go. The granddaddy is the IRA, the Individual Retirement Arrangement. Is that what it really stands for? Yeah, that's the actual name, but nobody uses that. Everybody calls it the Individual Retirement Account. It's the most popular personal retirement account. It's now, as we said, referred to as the traditional IRA to differentiate it from the Roth IRA. And here's where some confusion starts to set in. It's the tax code, remember? Anyone with earned income can contribute to a traditional IRA. Anyone. Doesn't matter how much money you make, you can still contribute to an IRA. Now, here's the condition. Sometimes those contributions may not be tax deductible. They normally are, but if you have a retirement plan at work, if your employer offers a 401k or some other employer-sponsored plan, and you make over a certain amount of money, then you can still contribute. You just cannot deduct them from your income taxes in that year. So here's where it gets a little tricky. You're going to have some part of it that's post-tax and some part that is after tax. And so you have to keep track of your end of year statements in perpetuity. Because when you go to take the money out, you don't want to be taxed twice. You want to say, hey, this was, post-tax. I don't have to pay taxes on this again. I don't like this, but that's part of the tax code. The investment grows tax deferred, and you pay taxes on the money as you withdraw it once you're in retirement. Normally, after 59 and a half years of age, mandatory withdrawals. Once you're 59 and a half, you can take the money out without any penalty. You still have to pay the taxes. And there is a way actually you can take the money out before without paying taxes, but then you have to go to the IRS and say, I'm 58 years old, I want to retire now. And they bless it and kiss it, and they give you a schedule on how to take the money out. But it used to be that you had to start taking the money out at age 70 and a half. Well, now it's 72, and eventually it's going to be 73, and supposedly it's going to go up to 75. Oh, well. So remember that once you get older, because if you don't take the money out, the penalties are outrageous. They're just ridiculous. 50% of what you were supposed to take out. Now, I've known people who didn't do that because they didn't really understand what they were supposed to do. And I said to them, start taking it out now. And the IRS never came after them. I think the IRS realizes that people are confused about this too. But they might. So do what you're supposed to do. Take the money out once you hit 72, and then 73, and then 74, and then 75. Excuse me. And the IRS has many cousins and siblings and in-laws. The 401k for corporations and private businesses, the 403b, the 457, the 408, 401A for public organizations, the SEP IRA, the Simple IRA, the Solo 401K, the SARSEP, the KEO. Those are all for smaller businesses. And as we said, the KEO and the SARSEP are no longer available for new plans. If you have one, you're grandfathered in. The SEP IRA is cool if you are a sole practitioner because it allows you to put away a lot of money. Say you're a doctor just working by yourself or a lawyer or something like that. The Simple IRA is great for small businesses that really don't want to deal with the headaches of 401ks, and they're very, very simple. I'm a big fan of the Simple. The Solo, obviously, it sounds, for somebody who's basically a solo practitioner, and forget the SARSEP and the KEO. What I like about the KEO, though, is the name, KEO. It reminds me of the Wizard of Oz at the end where they're going, yo, he, yo, KEO. Yeah, I know, it's bizarre where my mind goes somewhere. Anyway, the big cousin now, the big brother, the little brother, the Roth IRA. Very, very cool. Post-tax contributions. And again, the Roth 401k, the Roth 403b, we put in quotes. They all work very much like the traditional IRA, except for the Roth options, except for the after-tax options. So let's take a look at an example of a 401k, 403b, traditional IRA. You contribute via your paycheck or your checking account $100. Now, it depends on what tax bracket you're in. And we talk about this in detail in the BUS123 Principles of Money Management, used to be called Financial Planning and Money Management, because it is important to understand your marginal tax rates. Most people don't. But let's say you're in the 25% tax bracket for the feds and the 8% for the California, which is not usual, but it happens. So look, you put in $100. Now the feds are going to give you $25. The state of California is going to give you $8. Well, not really. They're just going to take 25 fewer dollars for federal withholding and 8 fewer dollars for California withholding, which means you get a government subsidy of $33. You see your take-home pay only reduced by $67 if it goes through your paycheck. And of course, if you give it through your, if you contribute through your checking account or your savings account off from your bank, or you write a check, you're not going to see this. You're just going to have 33 fewer dollars to pay to the state of California and the feds. And we're not even discussing any potential matches that your company, if you have a 401k, gives you. Some companies will give you 50 cents for every dollar you put in, up to a certain amount, or $1 for every dollar you put in. So you put in $100 and you're going to get an extra $50 or maybe $100. Now, who's going to give you a 50% or 100% return on your money in one day? Only your boss, right? I know you don't like your boss, and I don't blame you sometimes, but this company is going to be very generous to you. Why? Because they want you to go away when you retire. Because it used to be that they would take that same money and put it into a pension fund that they had to manage. And then, of course, if you worked there all your life, you'd get a pension from that company. But those are gone. Those are going away or gone because, first of all, people don't usually work for 40 years for the same company. And also, it just makes more sense for the money to follow the employee, right? Because you might not work there very long and you're going to go to another place. There's potential great advantages to that, and there's potential disadvantages to that. We could discuss those at detail, but think about it, folks. By investing prudently and wisely, consistently, with an eye toward long-term growth of capital and income, you could build for yourself a pension plan that would make the pension plans that the folks, 100 years ago, 50 years ago got look weak. Yeah, you could do a whole lot better. But you could do a whole lot worse if you don't contribute consistently, or you chase after every next big thing, or you panic when the markets fall. So it's a dual-edged sword. But it's still very, very cool. You put in $100, you only see your paycheck reduce $67, plus you might get an extra $50 or $100. What's the catch? What's the catch? Slide 14. Well, you pay income tax on any amounts withdrawn in retirement, But as we said, people in retirement are usually in a lower tax bracket, and if you're not, congratulations. Too much champagne, what shall we ever do? And if you withdraw the funds before retirement, you pay the income tax and you must pay a 10% penalty. Now, the IRS doesn't call it a penalty, they call it an additional tax. It's a penalty. But there are some exceptions. First-time home purchase, I think the amount is still $10,000, which is woefully inadequate. They should raise that. Higher education for you or your children. Medical disability, financial hardship, which my understanding is it's hard to get accepted by the IRS. So you're not going to touch this money for 30, 40 years. You're going to give it a kiss, send it on its way, all right? And then it's going to come back to you manyfold, assuming you were consistent, prudent, long-term oriented investors, which you all are now. Thank you so very much. Slide 15. Now, how about the Roth IRA, the fourth Roth 401k, 403b? You contribute $100, either through your checking account or your paycheck. What do you get back from the feds? Or the state of California? Yeah, right. Nothing. They don't give you anything because it's after tax. You have to pay the taxes before you put the money in, and then the money is after tax or post-tax. So your disposable income is reduced by $100, and of course, we're not even talking about any match that your company might have given you. So why would you contribute to a Roth IRA? Well, here's the answer, folks. Because you're going to do it, right? I think hope is hope. And eventually people are going to say, well, why do you contribute to a Roth IRA? And here's the answer. Because a Roth IRA is so cool. Tax-free in retirement is a golden opportunity. No other investment account option comes close, in my humble opinion. There's some scenarios that you could work out. Well, it made sense better for you to pay the tax, whatever, just whatever. Tax-free in retirement is a golden opportunity. And I think, I've been thinking about this for a while, but maybe it's not going to happen because old people vote. I'm one of them. But I think they're going to get rid of them. I think they're just going to say, okay, no more new Roth IRAs. If you have one, you can keep it, but we'll see. They're very popular. Plus, here's the very cool thing about the Roth IRA. You can withdraw the contributions at any time without penalty because you already paid taxes on the contributions. Right now, there's some things that say you have to wait 5 years. I think that's for something else. I think that's if you've we have to find that out because someone just said, oh no, you can't do it right away. So yes, you can. I know people have done it. Maybe they just didn't get caught. But some people say you have to wait 5 years. I think that's for the conversion. If you convert your traditional IRA to a Roth IRA, then you have to wait 5 years. But I don't think that's not the case for the contributions because you've already paid taxes on them, right? They're yours. This makes the Roth IRA also an excellent intermediate term investment account. Purchase of a house or other high ticket item, great for college expenses. Why? Because when you filled out that FAFSA form, not the FAFSA form, but the FAFSA form, they didn't ask how much was in your Roth IRA. They ask how much are in your checking accounts, savings accounts, but they don't ask how much are in your retirement accounts. So when people say to me, especially in our income brackets, I'm not the very wealthy, but should I put aside money for my son or my daughter's education? I said, in an educational savings account. I said, have you funded your Roth IRA yet? And they say, no. I said, do that first, okay? Because you put money into into an educational savings account, a 529 plan, I forget the other one called Coverdell or something. Whatever money you put in there is going to be taken away from your financial aid if you qualify. Plus, you don't get to take advantage of the American Opportunity Tax Credit and the Lifelong Learning Tax Credit. So it's really a big disincentive for people in the middle class. Now, if you know that you're not going to get any financial aid, you're very wealthy, then sure, put it in a 529 plan. It's actually a very good deal. Okay, cool. All right, so Roth IRAs are so cool. But let's see if you can, slide 17. Oh my goodness, see if you can follow me on this. We're not supposed to say a Roth IRA is for everyone, but I say that because it's true. There is a way for you to contribute to the Roth IRA, even if you make over a certain amount of money. There's a limitation on the Roth IRA contributions. In 2023, only single taxpayers with an AGI of $138,000 or less and married couples with an adjusted gross income of $218,000 or less in 2023 can fully contribute to a Roth IRA. And if you don't qualify, congratulations again. I don't feel too sad for you. But guess what? This is how broken our tax code is. And if you can follow me, great. And if you can't, don't worry about it. Just know that there's some it's called the Roth IRA backdoor. You can still contribute to the Roth IRA anyway, because some people don't know they're going to go over the amount until the end of the year. If you find that you've made over the limit, you can recharacterize. That's the verb that the IRS uses. Recharacterize the contributions into a traditional IRA, which doesn't have the same limitations as the Roth IRA, before you file your taxes. And then you convert the traditional IRA to a Roth. What? Yeah, you take the Roth IRA, recharacterize it into a traditional IRA. Now, I think you should do it before the end of the year, but you have until October of the next year to do it. You then convert the the traditional IRA back into the Roth. I know who voted for these bozos. Oh, yeah, we did. So it's called the Roth backdoor. And there was talk of getting rid of it, but it still stands as of 2023. Slide 18. Here are the current contribution limits for 2023. For people under 50, $6,500. And if you're 50 or over, you get to add another $1,000. Starting in 2024, $7,000 for people under 50 and $8,000 for 50 or over. So, for the traditional and Roth IRA, contributions are limited to the lesser of your gross salary or your maximum yearly contribution. So that means, in other words, if you made at least $6,500, you have until April 15th of 2024 to put the maximum into an IRA or a Roth IRA for 2023. Now, you can't put $6,500 in an IRA, traditional IRA, and $6,500 in a Roth. No, it's the total between the two of them. You can mix and match, but it can't be more than $6,500. And your spouse is also eligible for contributions even if he or she does not work. The contribution limits rise with inflation, as we're going to see on the next slide, and we saw on this slide, for 401ks and 403b employer-sponsored plans. So we're going to see that as the years go by, this number is increased with inflation. And it's going to happen in 2024 for the IRA and the Roth IRA, and of course for the 401k and 403b, because these are much more generous contribution limits, aren't they? Oh, yes, they are. Look, where they started in 2020 and now 2023, this year, $22,500. And of course, if you're 50 or over, you get it's called the catch-up allowance, just an extra amount that you can put in. So in starting in 2023, $23,000 and an extra $7,500. Pretty darn generous. Yes, so for employer-sponsored plans, contributions are limited to the lesser of your gross salary or the maximum yearly contribution. In other words, in 2023, if you make $22,500, you can put the entire income into your 401k or 403b or 457. And as noted, the amounts are now indexed and go up over time. There's also a loophole in this law that allows people in the public sector to contribute $22,500 into a 403b and the same amount into a 457. Or if you're 50 or over, $30,000 into each. Very generous. Now, folks, think about this. What we've learned about, compound interest and future value and the like. If you're in your later 20s or early 30s, let's say you're married, one person can take their salary, assuming you can live off of one person's salary. One person can take much of their salary, stuff the whole thing into the 401k or as much as they can, and you do that while the other person, brings home the bacon to live off of. You do that for 5 years in your later 20s or early 30s. You'll never have to put another dime into your retirement accounts. And I've had people say, "Are you sure? I don't believe you." I said, "Come on to my office or over the internet. Let's over Zoom online. Let's show you the illustrations. If you pick the run-of-the-mill, well, no, I like to pick good mutual funds, but let's just say you pick the decently run mutual fund, put that money, 5 years worth of maximum contributions into a 401k, and let it sit for 25, 30 years and see what happens. The results are astounding. Now, someone might say, well, I don't. What if we get divorced and he takes the whole thing? No, when you get divorced, the 401k, the traditional IRAs, all the retirement accounts are on the table, and they usually get split up, 50-50 or whatever. So don't worry that the jerk is going your spousal unit is going to abscond with the retirement savings. Slide number 20. As we mentioned, I should put quotes around these guys. There's a Roth option. The IRS doesn't call it that. They just call it a 401k or a 403b with after-tax contributions. So your employer doesn't have to offer it. If they offer a 401k, they do not have to offer the after-tax contributions, but usually they do. Excuse me. If your employer offers the option, you are able to place after-tax dollars into your Roth 401k or Roth 403b. Similar to the Roth, however, there's some wrinkles here. If the employer matches, those will be pre-tax contributions, okay? So you're going to have pre-tax and post-tax, and contributions are not be able to be withdrawn without penalty or taxes until retirement, unlike the Roth 401k. So here's what you got to do. You have to save your end-of-year statements so that later on, when you go to take the money out, the IRS doesn't say it's all taxable. No. This part was after tax. This part is pre-tax, before tax, after tax, pre-tax, post-tax. So you don't get taxed twice. Now, this is a great option for those who do not need the tax break now. However, unless your employer offers matching contributions, I prefer the Roth IRA. Why? Because I just don't want to have that headache of what to do with these 401k accounts, these 403b accounts later on. And what I've done is I put pre-tax money into my 403b at Southwestern and 457 and put our post-tax money into my wife and mine's Roth IRA, just for the sake of simplicity. Probably would have been a better idea to put more into the 401k, the 403b and the 457 after tax for the tax consequences later on down the line, but oh well, it's not a perfect world. Slide 21. Now, excuse my voice here. If you do your own taxes, do not forget that you could be eligible for a tax credit. Now, I don't know about you, but $73,000 for a married filing jointly is not that low. $36,500 for a single filer, and then for head of household. You may be eligible for up to 50% of your contributions, maximum of $2,000. So, for example, you put $50 a month into a Roth IRA. You may get $300 back in tax credits, which that's pretty darn good, right? You put in $600, you get $300 back. So don't forget this. Now, if you have somebody do your taxes, bring the statements. Here, this is how much I put into my 401k. This is how much I put into my Roth IRA. Tax programs such as TurboTax, TaxAct, Tax Slayer, all those programs, H&R Blockheads, they handle these very well. Assuming you put the data in, it'll say, oh, you get a tax credit. Very good. Well done. Now, slide 22. Here's where I put my mean face on. What is an annuity? Well, annuity in and of itself just means a series of payments. But annuity is also an insurance product, a life insurance product, designed to provide a guaranteed income. Annuity options include income for a set number of years for as long as you live. That's the life option, the life certain option. Or for as long as you and your spouse or other dependent lives if he or she outlives you. The amount you get is based on your age, which of the above options you pick, how much you have contributed, and how well your annuity investments, if any, have performed over time. Now, there are dozens of these different types of annuities, but they fall into basically two different categories. A fixed annuity, which invests in bonds, but you don't know that. They do it for you, which says you're going to get 4%, you're going to get 3%, you're going to get 5%. Or variable annuities that invest in mutual funds that, of course, could invest in stocks or bonds. Okay. Right. What's going on here? Well, the variable annuity, not only are you charged the mutual fund charges that the mutual funds charge, but the life insurance company also tax on 2, 3, 4% on top of that. Ooh. What are the advantages and disadvantages of tax-deferred annuities? They can be funded with retirement account dollars or after-tax dollars. So they're very flexible that way. There's no limit on the contributions as there are with the IRAs and the 401ks and 403bs. The interest earned is tax-deferred, and when you go to retire, you pay taxes on any pre-tax annuity contributions and all tax-deferred earnings as you withdraw them in with retirement. Any post-tax contributions you don't pay taxes on. Again, yeah, that makes sense. And as with other retirement plans, when you retire, you will likely be in a lower income tax bracket. Now, what's the downside? You know, folks, if you don't have any ethics and you can sell these things, you can make a ton of money. Really, folks. Life insurance agents who sell these things can make a tremendous amount. In fact, they'll give you an all-expense trip to the Caribbean on a cruise. I mean, these things are very, very lucrative. Annuity companies usually take 1.5%, 2%, 3%. I've seen up to 4%. That's on top of any mutual funds fees if it is in a variable annuity. But they offer great commissions for the life insurance agents. So if you don't have any ethics, yeah, and they usually come with very restrictive provisions. Do you remember the B shares of the mutual funds where the first year, if you took it out, they took 4%, 3%, 2%, 1%, and after 4 or 5 years, they didn't take anything? Well, these things start with 25%. And that, or 20%. It takes 20 years to get rid of those surrender fees, the big jerks. And I have a presentation I want you to take a look at from TIAA, which is a very good company, folks. I'm not trying to badmouth TIAA, Teachers Insurance Annuity Association. But they're out there, folks, and some of them are even worse than TIAAs. So check out the difference in the amount you will get over 25, 30 years than if you invested on your own prudently, wisely, with an eye toward long-term growth of capital and income. And it sounds like an advertisement. My apologies. But yeah, in the presentation, I talk about how some insurance agents don't get very happy. They get a little riled when you badmouth annuities, but they deserve to be. So there. Go ahead, sue me. See if I care. I just love to be able to show in court the different illustrations of what you're offering people and what they can do on their own, assuming they see what the insurance company's going to say. But they'll waste it all. They'll spend it all. They'll chase after every next big thing, and then when the market falls, they'll take all their money out. And they might be right. You know, some people might do that. But if they take in this class, I'm sure hoping they don't. Now, for some people, there are some instances where an annuity might make sense. Let's say somebody's going to come into a very large sum of money, and you know this person is just going to spend it all in 2 years or so, 3 years. If you put it into annuity, when you bequeath it to them or whatever, an heir, your beneficiary, then yeah, they can't. They're kind of stuck. So maybe that makes sense, but that's very unusual. So slide 24. To review our choices, there are regular accounts that you pay taxes every year, no limit on your contributions, no limit on what kind of investments you can have. And then there are pre-tax contribution retirement accounts and post-tax contribution retirement accounts. And my favorite being the Roth IRA. Pre-tax, you get a tax break now, pay taxes later. Post-tax, you pay taxes now. Did I say that right? What did I say? Let's start again. Pre-tax, you get a tax break now, pay taxes in retirement later. Post-tax, you don't get a tax break now, but tax-free in retirement. Yeah, I did it right. And then annuities, high fees, but you get tax-deferred earnings. Cool. And as I said, there are educational savings accounts, health savings accounts that, basically variations on a theme. Same ideas. Okay. And that is our discussion of brokerage firms and brokerage accounts, account types, and annuities. And for our very last chapter, our very last presentation, we'll discuss the ultimate investment, starting a business. Oh my goodness, dear students, we're almost at the end. Thank you so much for being with us. We're so proud of you.